Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global market specialist, Giles Gale, Theo Chapsalis, and Jan Nevruzi. Before getting into the discussion today, I just wanted to remind you, if you like this podcast, to hit the like button and don't forget to subscribe so you can get the latest episodes as soon as they're available. All right, everyone, welcome back. Happy New Year. I hope you all had a good break if you managed to get some time off. Markets have really hit the ground running this week. We've had lots of data, FOMC minutes, and fairly big market moves. So without further ado, let's get into this week's discussion. Jan, I'm going to start with you because we had the FOMC minutes last night. We're recording this on Thursday. So we had those on Wednesday night, and it's really, I would say, that has kind of led the tone for markets over today and last night in the US. So markets took those minutes fairly hawkishly. What really did we learn from them? I guess particularly the focus was on the discussion around quantitative tightening, or QT as we might call it. And do you think the kind of market interpretation of being hawkish was the right one?
Yeah, I think the market certainly reacted in the right way. I mean, it's just hard to deny that these minutes were hawkish, more hawkish than what most people expected. For one, going into it, I wasn't exact 50-50, but pretty close on like whether we're going to get anything substantial on quantitative tightening. We knew they were going to discuss it, but there was a chance it could have just been like a one paragraph, mentioning like, oh, we're looking towards reducing our balance sheet in 2022. It wasn't that at all. It was none of the, go into taper. We had discussions about discussing taper. It was like very in small bits. This time it was, in December, they agreed on accelerating taper. And at the same meeting, they had a huge discussion about balance sheet reduction, which pretty much removes all doubt that we are likely to see a start of taper at some point this year. So the discussion point was very clear. They made it clear that it's in the works, it's happening, and January will probably face another serious debate. On the sequencing, the more extreme, the more hawkish side of the aisle was kind of talking about they could hike, and at the same time they could announce QT. I think they sort of poured a little bit cold water on that by saying that QT is going to start after the liftoff. But they did say that it's not going to take as long as the last cycle, which was about 2 years. That doesn't give us too much because I don't think anyone at this point expected 2 years between liftoff and QT. But it does tell us that it's going to come after, and it could come, a quarter afterwards. It doesn't have to be at like 1% or above 1% for the federal funds rate. On the modalities, how they're going to go ahead, we didn't get, of course, the breakdown of what they think of the speech should be, but the comments, there are a couple of comments that sort of alluded that it could be, this time it could be a little bit faster. The size of the Fed's balance sheet compared to GDP is much larger. There's still an ongoing academic debate whether the flows or the stock, aka QE, buying or selling, or the total size of the balance sheet matters more. The Fed has often in the past leaned towards the size of the balance sheet mattering more. So we could argue that since the percentage of the balance sheet as the economy is much larger, they're providing more support. So there's a case there to be made that they should go faster. Additionally, they pointed out that the weighted average maturity of the holdings is lower now, which would allow them to run down faster just naturally through maturities by not reinvesting, bar any self-imposed caps. And finally, as it has been a lot in the headlines too, we can see that there's a lot of extra liquidity in the system, that reserves in the system that just get flushed back into the overnight RRP facility of the Fed. So that was also pointed out that it could be one of the reasons to say, look, we have about $1.5 trillion of unneeded reserves in the system right now, or at least reserves that cannot find an investment in the alternative market. So there's plenty. And finally, and this is where I was sort of a little bit deferring with the common view that it could not be a problem, is that they discuss the amount of target reserves, or how far should QT go. The answer is that they didn't have an answer. I mean, recent research has also been kind of pointing that they don't know exactly post-COVID, post this new fiscal spending, post the massive amount of liquidity that was injected into the system. They don't know what's the exact amount of reserves that is needed for the banking system to function properly and for monetary policy to transmit effectively. But they're going to, to keep a close eye on it. And at this point, they have a comfortable buffer before they get to a problem. But if they go with a faster speed than last time, we could see some trips in the path towards balance sheet normalization. So I think those were the key points that we got from the minutes. Very hawkish.
So you mentioned a little bit earlier about sequencing, kind of the timing between, a potential rate hike and then quantitative tightening, QT. How does, I guess, and what we learned from the minutes this week leave our expectations for the path of tapering from here onwards to then how we see rate hikes over, let's say, the next year or so, to then when we might see balance sheet rundown?
Right. So we had going to the minutes. We had 3 hikes for the year, starting from June, September, December. We're not going to change our total amount of hikes for next year. We still think they're going to deliver 3, but now adding QT in the equation, it likely implies that they're going to use one of the, let's say, if they're going to go quarterly, they're likely to use one of those hike meetings for announcing quantitative tightening. So it opens the door for an earlier hike, possibly even in March. We're still actively debating this within the team too, but so far the possibilities are looking more and more like it towards a March. We haven't made that official call yet. But the market is also pricing 75 to 80% chance for a March hike, although it's still confined to 3.5 hikes at this point. It's just 4 plus QT seems a little bit excessive unless they really, show a little bit more panicky, fast-moving reaction. But so it looks like, for example, June could be the announcement or the addendum. The announcement for QT saying we're going to, kind of go on in like end of September, begin from end of September, where all the modalities presented.
All right, heard it here first, Bondcasters. So finally then, I appreciate we're recording this, as I say, on Thursday. So it might be a little bit of a harsh question to ask you, given that by the time listeners do actually listen to this, then they probably will have the benefit of knowing what the NFP print was tomorrow on Friday. But how important do you think that print is, without really asking you specifically what you think it's going to be, and how much might a weak print matter, I suppose, in terms of knocking the Fed off that course that you've just laid out?
I think it's a little bit skewed towards strong numbers could open up room for justifying more aggressive reaction, more hawkish, and weak numbers could just kind of be staying the course right now, because the Fed already in the minutes also mentioned that they don't think that there's any need for accommodation at this point. They just cannot really pull the plug right away at the December meeting. So they kind of made the closest thing that they thought wouldn't really spook out markets, which was announcing a faster taper. But they don't think there's a need for accommodation. So it just opens up all sorts of different scenarios if we get strong numbers that they could go in March. I mean, the ADP numbers this week showed massive beat. They're not always correlated, but if we are to judge by that, these could be famous last words. But if we're to judge by that, the NFPs could beat and open up the room for a serious conversation for a March go.
All right. Well, we won't bring it up next week if they were famous last words, don't worry. Okay, then moving over to Europe then, Giles, because Europe has joined the US in this, or European rates have joined the US in this big shift higher this week. We're not actually that far from positive yields now in 10-year bonds. I think as we record this, we're about 5 basis points away. What do you see as the kind of main drivers behind this move, and how much further do you think this can really go?
Yeah, well, we got a little bit excited already this this week. I mean, I guess, if we're honest, we're probably not going to get there today or tomorrow, although never say never. But I think that obviously we've been helped a little bit by a roll in the Bund. That means a new slightly longer Bund benchmark has come along and sort of given us a little bit of a boost up towards 0%. But that just compensates for the fact that we were getting dragged shorter and shorter before, so fair's fair. Listen, I think we'll get there. I think we'll get there pretty quickly. You're about your question about what it is that will, why it is that we've moved so far so quickly. And I think the simple answer is that we had a bit of a panic about this new variant, new old variant now, Omicron, in December. And, over the last couple of weeks, that panic has kind of dissipated as people realized that perhaps it wasn't as disastrous as all that, and maybe didn't mean that we had to completely rewrite our forecasts and the whole playbook really for next year. So I think that that's a very large part of it, and I think that also the clarity of the ECB back in December, that matters. Remember, we had, in fact, in our last podcast, we talked quite a lot about that. We've had a hawkish shift globally, and I think just people in a very small way starting to put new risk on, right? I think that most people, from most of our discussions with investors last year, there was a general sense that we weren't really at the level of yield that most people thought were necessarily aligned with the way that they actually saw the world. Simple as that. But because the second half of last year had been so painful, because the market had been sort of dominated by these kind of positioning squeezes, and it was all sort of felt, it was all quite tactical and tight. I think people were not really expressing that, and so in a small way, and in light markets, they've started, so some people who have been in the office have maybe been just trying to push it a little bit, just get ahead of a move that they're anticipating. So what have we got now? Well, we've got a lot of supply coming up. We, I think we'll see, I hope anyway, the peak in for this current wave of the pandemic, and honestly, I think that we will shift from that to an expectation that maybe actually it sets us up quite well for a sort of a less worrying time for the next several months, and we can focus on the main things, which are stronger growth, higher inflation, central banks starting to do things. So that's why. How far can, your other question is, how far can it go? A lot further. And I think it can, and I think it'll go quite quickly.
Okay, that's good to know. You touched on it a little bit there, but I guess one of the themes, always really for us in Europe in Q1 is about kind of front loading of supply and how easily that can be met with a kind of wave of demand as investors have cash to put to work at the beginning of the year. What's your view on that this year? Do you see significant front loading, and I guess more importantly, do you see that being met by enough demand to kind of keep the market supported or not?
Right. Yeah, there will be reasonably significant front loading. I think across the non-government sector, there's a general understanding that the sooner you can come to the market, the better, really. I think most people understand that it's better to try and, if you've got stuff to do, better to do it when you've got the cover of the ECB with its CSPP and PEP and so on. And I think that generally speaking, being bearish rates isn't just an investor theme. It's also, issuers very much have an eye on that. They're worried a little bit about their credit spread, but they're also worried about the rates dimension as well. So I think, there will be, it won't be dramatically different to other years, but I think that the pressure is definitely there. So yes, I think non-government front loading will be pretty strong. Governments, they'll probably, they'll keep roughly to the plans that they always have, but that always involves a significant degree of front loading. So yeah, there's going to be a lot of supply, and different to last year. It sounds like from the feedback that we've got there, there's a reasonable amount of cash because there wasn't a lot of primary last year. So so that's maybe a little bit of a risk to everything that I was just saying. But I think that in contrast to a certain extent to last year, people can sort of sense the turn. Last year at this stage, there was still a lot of pandemic uncertainty. There was quite a lot of macro uncertainty in general, and we didn't have the central banks accompanying the turn in the same way. And so I think that you will or at least what I would expect is that investors will be more patient about waiting to step in to this market, particularly at these sorts of levels. So that's what I think will help get us to the higher rates that we're talking about.
So just finally then, and I'm sure that this is actually a theme that we'll return to in future pods because, it's still a couple of weeks away, but our minds have been focused by the fact that a date has been set this week for the Italian presidential election at the end of January. That, I guess, brings about the first kind of dose of political risk for 2022 in Europe. Is this a real, genuine political risk that we should be concerned about, or is this something that you think might blow over quite quickly?
I mean, there isn't necessarily. I mean, it's going to be a little bit. I guess I was going to say messy. That's not quite the right word because it seems like it sort of overstates it. I mean, but the concern, of course, is that if Draghi becomes the next president, then on the one hand, of course, that's arguably great news from the market's perspective because you have 7 years more Draghi. But on the other hand, it unsettles the current coalition and maybe just raises a couple of question marks about execution risks and so on around the RRF, the recovery fund, and the current sort of reform progress and so on. Overall, we're not that concerned. I mean, I dare say we'll come back to this because the basic thing to say is that in addition to a timeline, we don't actually have all that much information, and we always knew that this was going to be this month. So Draghi's definitely the front runner. I think probably the market's base case that he will opt to try to become president, and I'm sure if he wants it, he can have it. So what does that mean? I mean, you can see that BTPs are having a little bit of a struggle this week, and we always thought that was on the cards, to be honest with you. But overall, I think the prospect of Draghi as president plus. Honestly, I think it's more likely, even if he does move on, I think it's more likely than not that this current, or some form of this current coalition will continue, and we won't have elections until 2023. And that's really what the markets are most concerned about, because that would be the way that you would have a right or some, let's say, far right government come in that might then kind of upset some of the more market positive stuff that's been coming out of Italy over the last couple of years. So let's just come back to this in the next couple of weeks, I think, Imogen.
I did say it's something I think we'd come back to, but I guess that you made the key conclusion there that even if we get some kind of short-term worries, then the risk that the market's really concerned about of kind of crisis and back to kind of 2018 sort of thought processes is quite low, we think. All right, then let's move over to the UK. The UK markets were closed on Monday when Europe and the US did a lot of their movement, but the UK did a fair amount of catching up when we eventually came in on Tuesday. Now, Theo, your long-held, long-term target for 10-year gilts has been 1%, but we're now quite a bit higher than that. And I know you've been updating your view around the kind of more tactical short-term outlook. So perhaps you could just update all of our listeners on what your thinking is there around your near-term target for gilts.
Absolutely. So listeners will probably know that since March of 2021, we've been arguing for 1% as the equilibrium for the 10-year rate. And we've kept that view when yields were at 1.2 and when yields were at 0.7%. So we thought that, there is not going to be something particularly meaningful. There will not be a meaningful deviation. Right now, we think that for the next 2 quarters, there will be a shift actually higher. We've been outright bearish gilts since December. Basically, we closed any long position that we had, and then we had break-evens, so long back and break-even positions as a way to play that bearish theme. right now, and this is actually the valid point, we move the forecast to 1.35% for the next quarter. So we talk about 20 to 25 basis points, of an upside based on where we are. Okay, fine. What is the rationale? What are the reasons? Well, first of all, there's been a shift in terms of politics and the language that we get from the government with regards to lockdowns. Lockdowns now seem to cost. So basically, this is significant. It's not all about the NHS and saving the system. It's about the economy. This is important, i.e., even with high cases of Omicron, a lockdown or actually restrictions that will slow down the economy are less likely. Two, we talk about the BOE, and the BOE, they've considered the risks to inflation and the risks that are emanating from Omicron, and then in December they delivered a hike. Well, since then, actually, the information looks even more supportive for their action, i.e. Omicron, even though it has been very prevalent, it has not been very, very disruptive. Then we have themes such as issuance, and we'll be talking about the syndication in February. It will be a big theme. We'll be talking about duration coming back in the market, and people who held gilts, they held gilts more as an optionality to benefit from a potential squeeze in duration, in December, because you don't have supply. And if indeed Omicron was to prove, to be very disruptive, then there would be a huge demand for gilts, but obviously this did not materialize. So those who had gilts preemptively as protection, as an instrument of protection, actually they are getting out of it. We also think that inflation will be quite a key topic, and continuously high inflation. Now, will it be up at 7%, 8%, whatever? It's going to be a high number, sufficiently high for the BOE to keep talking about it. So these are the reasons why we think that there will be a move in yields higher.
You mentioned it, in your kind of list of rationales, but perhaps I could just dig a little bit deeper, given that I asked Giles the same question as well. And I think one of the key drivers is around the kind of supply outlook for the next few months, but also not just the supply outlook, but I guess, again, like with the Fed, this idea that, QE has ended and there may even be quantitative tightening coming in the UK as well. So how do you see, I guess, supply matched up with a lack of Bank of England support over the next couple of months?
This is a fantastic question, because it's actually a key point when it comes to understanding the gilt market. And for several years, we had either active QE, net purchases, positive net purchases, or we had reinvestments. Now we have a situation where the BOE, to the extent that they deliver a hike in February, which is quite likely, they will not reinvest 28 billion of a bond that matures. Now, is this relevant? Well, 28 billion that are not being reinvested, that's worth 50 million a basis point. This is quite a big deal. This is the DVR that you get from two very big syndications. So yeah, it is a big deal whether that money is reinvested or not. Issuance is something that will become more meaningful after April. And the reason is really because there has been a significant reduction in gilt issuance during this financial year, but then supply issuance will become more normal after April. And again, valuations will become more normal. Valuations will become cheaper. Now, the other point is really, if you don't have an active buyer, the propensity for gilts to gap richer becomes smaller. So you could buy gilts and then hold them into the APF operation. And then, if the APF operation, APF stands for Asset Purchase Facility. So if the QE operation was particularly strong, then you could offload them. So this force is getting weaker, which is important, which means that the equilibrium for yields will be weaker. Now, the question that probably you will bring up is, well, we mentioned all those arguments about balance sheet reduction, and the BOE. We know that they are really, really keen to reduce the size of the balance sheet, but why not target, for example, 2% 10-year yields, right? Why 135? Because it is an increase, but it's not the increase that right now seems to grab the headlines. And to me, the important point here is that there is a lot of appetite also from the demand side, i.e., yes, we do have a fundamental backdrop, and we understand that yields will have to go higher, but there is huge appetite to buy fixed income, if it is at the right price, obviously. And to us, it's not going to be, yields just going up directly. It's really, you will have levels, and then you will have some support. And the other point is really, we need to see to what extent, how fast the BOE actually does deliver those hikes. Because mind that we do have high expectations into 2021. So, 2022, not 2021. It's a new year. I still think that it's 2021. But the expectations really are for the bank rates to go to 125 at the end of the year, which is, it's fairly high. So to us, there can be a case that some of those expectations are being disappointed. So this is why we think that, yes, the trajectory and the direction, and we need to make a case for yields higher, but we think that this is something, more, let's say, tactical rather than totally structural.
Okay, that makes sense. Thanks, Theo, and thanks to Giles and Dan as well for joining me. We've got off to a very exciting start to this year, and I only hope that the rest of the year continues in the same way. So thank you everyone again for joining me. And just another reminder to our listeners that if you liked today's episode, then show your appreciation by clicking the like button, and don't forget to subscribe so you can get the latest episodes as soon as they're available. And another reminder as well that you can ask any questions to me or any of the other Bondcasters that we can answer live on the pod if you just email them to bondcast@natwest.com, and we will pick them up there. Thanks again. See you next week.